September 16th, 1992, 8 a.m. London is awake, and the British government is already losing £2 billion an hour. Not to war, not to disaster, not to hackers, but to the market. No alarms, no riots, just money quietly leaving. By nightfall, over $10 billion of public wealth will be gone. Not stolen, not destroyed, redeemed. The newspapers will call it Black Wednesday. Politicians will call it sabotage. History will call it inevitable. Because this wasn't a crash, it was a test. And Britain failed. Inside the Bank of England, the air smells like expensive coffee and fear. Phones won't stop ringing. Screens won't stop flashing. Every decision costs another fortune. The British pound isn't falling. It's being questioned. And once markets start asking questions, they don't stop politely, they push. By sunset, the damage is permanent. Britain is forced to abandon a promise it swore it could defend. Interest rates have been raised, then raised again, then reversed. Credibility is gone, the pound collapses, and taxpayers inherit the bill. The headlines need a face. They choose one. George Soros. The hedge fund manager they blame, the speculator they hate, the outsider who made $1 billion in a single day by betting against a country. They call him the man who broke the Bank of England. It sounds perfect, it's also wrong. Soros didn't break Britain. He didn't cause the weakness. He didn't invent the flaw. He noticed something governments hate to admit. When power argues with reality, reality doesn't negotiate. It collects. Black Wednesday felt sudden, like chaos, like betrayal. But this story doesn't start in London. It starts decades earlier, with a boy who learned a dangerous lesson early. Systems don't collapse loudly. They whisper first. Before he was a headline, George Soros was invisible. Not powerful, not feared, just a survivor. He's born in Hungary, 1930. As a child, he doesn't study markets. He studies fear. When the Nazis occupy Hungary, authority becomes lethal. His father forges papers, changes names, creates roles. The family survives by pretending. By understanding one brutal truth early: power doesn't mean correctness, and systems can be wrong while insisting they're right. Soros learned something most people don't. When systems begin to crack, they don't warn you. They normalize, they explain, they ask you to wait until the ceiling hits the floor. After the war, another system takes over. New slogans, new promises, same certainty. Soros doesn't stay to see how it ends. He escapes to London, but he doesn't go to a trading floor. He goes to a library, and there, he becomes obsessed with one dangerous idea: reflexivity, the belief that people don't just observe reality, they shape it. Beliefs influence behavior. Behavior changes outcomes. Outcomes reinforce beliefs, a feedback loop. If enough people believe something is true, they act as if it is. And for a while, the lie works. Most investors chase numbers. Soros chases belief. Because markets aren't ruled by spreadsheets. They're ruled by confidence, fear, denial. Prices don't move because something is true. They move because people believe it is. Until belief becomes too heavy to carry. Soros isn't hunting companies. He's hunting moments. The exact point where confidence becomes performance, stability becomes theater, and defending a belief costs more than abandoning it. That's where systems break. Quietly, then suddenly. By the late 1980s, Europe feels unstoppable. The Cold War is ending. Borders are softening. History feels cooperative. Optimism is everywhere. And optimism wants permanence. So Europe makes a promise. It's not the euro yet. This is the rehearsal. Every country still has its own currency, but they agreed to bind them together inside a system called the Exchange Rate Mechanism, the ERM. Most of them anchor their currencies to one standard of strength: the Deutsche Mark. The logic is elegant. No wild currency swings, no surprises. Stability. Think of it like this. A group of countries tie themselves together with a single rope. If one moves too fast, the rope pulls them back. If one falls behind, the rope drags them forward. No one breaks formation. This only works if the economies move together, interest rates rise together, fall together, harmony. But systems don't fail because of bad intentions. They fail because of mismatches. At first, Britain stays out, skeptical, cautious. But in 1990, it decides to join. The thinking is simple. Tie the pound to Europe. Import German discipline. Control inflation. The pound is pegged to the Deutsche Mark. Confidence is high. The photos look historic. By 1991, the harmony is gone. Germany is surging. Reunification, investment, momentum. Britain isn't. Growth is weak. Inflation is higher. The economy is already strained. Same rope. Very different strength. Now Britain faces an impossible choice. To keep the pound strong, it must raise interest rates. But raising rates while the economy is weak is like dieting while you're sick. You might lose weight, or you might collapse. But if Britain cuts rates to stimulate growth, the pound breaks free and the promise collapses. The ERM doesn't adjust. It demands discipline. Even when discipline causes damage, to stay in, Britain has to defend the pound, constantly, buying its own currency, burning reserves, raising rates, over and over. The rope isn't stabilizing Britain, it's tightening. To politicians, this looks like commitment. To the public, it looks like responsibility. To George Soros, it looks like a countdown. Because every day Britain defends the pound, it spends real money to protect a belief. And beliefs get expensive right before they collapse. Britain isn't alone. Across Europe, pressure builds. Some countries blink first. Finland, Italy. They cut the rope. They abandon the peg. And when they do, the market learns something critical. This system can fail. Soros doesn't rush. He watches. Because when tension builds long enough, it doesn't resolve gracefully. It snaps. And when the rope finally breaks, it won't matter who was holding it. Soros doesn't try to fix the system. He doesn't warn politicians. He doesn't argue on television. He doesn't give speeches. He prepares. Because when a rope is under enough tension, you don't negotiate with it. You cut it. At its core, the move is simple. Soros shorts the British pound. That sounds complex. It isn't. You borrow something valuable. You sell it immediately. You promise to return it later. If the price falls, you buy it back cheaper and keep the difference. Now scale that up. The asset is a national currency. And the scale is billions. But Soros doesn't stop there. Because currencies don't fight in one place. They fight everywhere at once. Spot markets, futures markets, bond markets, different doors, same building. Pressure in one room spreads to the others. Here's the detail governments underestimate. Even bets on the future change prices today. If future prices drift too far from reality, money rushes in to exploit the gap. That rush forces the present to move. Futures don't predict collapse. They pull it forward. This is what makes the trade deadly. If Britain somehow holds the line forever, Soros loses fees and interest. Annoying. Survivable. But if Britain breaks, the pound falls fast and the profit explodes. Limited downside, massive upside. That's asymmetry. Every day Britain defends the pound, it burns reserves. Every rate hike hurts the economy. Every defense makes tomorrow worse. Soros doesn't need to be right immediately. He just needs Britain to keep pretending. And pretending is expensive. There's no single moment where Soros pulls the trigger. This isn't a movie. Pressure builds quietly. Other traders notice the flow. Volume rises, rumors spread. And once the market smells weakness, it doesn't forget. Britain is no longer fighting one fund. It's fighting momentum. Finland has already stepped aside. Italy has already surrendered. Every exit tells the same story. This rope can snap. Britain is defending credibility. Soros is trading arithmetic. Britain has voters, budgets, headlines. Soros has patience, and patience always beats pride. By now, this isn't theory. The trade is live. The pressure is visible, and both sides understand the truth. Something has to give. The only question left is simple. Who blinks first? The government or the market? September 16th, 1992, 7 a.m. London wakes up uneasy. Inside the Bank of England, phones are already ringing. Not with confidence, with questions. The bank moves immediately. They start buying pounds, not millions, billions. The goal is simple. Create artificial demand. Hold the line. 1 billion spent. Nothing. 2 billion. The pound slips anyway. Markets don't panic. They observe. By late morning, the tone changes. This isn't routine defense. This is fear. At 10:30 a.m., the bank makes a dramatic move. Interest rates jump from 10% to 12%. The announcement is meant to shock. It doesn't. The pound barely reacts. And in that silence, the market learns something crucial. The bank is running out of options. This isn't a surprise to Soros. He expected the hike. Before the announcement, he had already positioned himself against British government bonds. Because emergency rate hikes always break something else. While Britain fights the pound, Soros is already getting paid. Early afternoon, the bank panics. At 2:15 p.m., it does the unthinkable. Interest rates jump again, this time to 15%. In 4 hours, Britain does what normally takes years. It's not confidence. It's surrender without saying the word. Businesses freeze. Borrowers panic. The cure is worse than the disease, and the market knows it. By evening, there's nothing left to defend with. Reserves are bleeding. Credibility is gone. The decision is made quietly. No speech, no ceremony. Britain withdraws from the ERM. The rope snaps. The pound collapses. Soros goes to bed. No champagne. No victory tour. When he wakes up, the numbers are final. Roughly $1 billion from the pound. Hundreds of millions more from bonds and stocks. A fund, barely 3 billion strong, adds half its size in days. The press needs a face. They find one. The man who broke the Bank of England. It's simple, angry, memorable, and wrong. Soros didn't break the system. He exposed it. After leaving the ERM, interest rates fall. Exports surge. The economy recovers. The pain was real, but the policy was worse. Soros didn't destroy Britain's economy. He forced it back into reality. This isn't a story about greed. It's a story about denial, about what happens when belief replaces math, when speeches replace correction, when systems defend promises they can't afford. Markets don't care who's in charge. They don't vote. They don't negotiate. They don't respect prestige. They test. And eventually, they collect. Soros didn't cause Black Wednesday. He didn't invent the weakness. He noticed it. And he acted before the illusion collapsed on its own. That's why this story still makes people angry. Because if one man can expose a lie that big, what else are we pretending is stable right now?